On the outlook for financial stability, the committee noted that in spite of the banking subsector's resilience, the weak macroeconomic environment has continued to impact negatively on the stability of the subsector. The committee reiterated its call on the bank to sustain its surveillance of deposit money banks' activities for the purpose of prompt identification and mitigation of potential vulnerabilities. The committee also called on deposit money banks to support the quest to move the economy forward by extending reasonably low-priced credit to the private sector. In arriving at its decision, the committee took note of the gains so far achieved as a result of its earlier decisions, including the stability in the foreign exchange market and the moderate reduction in inflation. The option was whether to hold, to tighten, or to ease. These were subjected to extensive debate. As in previous meetings, although tightening would help rein in inflation expectations and strengthen the stability in the foreign exchange market, the committee felt that it would further widen the income gap, depress aggregate demand, and adversely affect credit delivery to the private sector. The committee also noted that tightening may result in the deposit money banks repricing their assets and loans, and thus raising the cost of borrowing and therefore heightening the already weak investment position and non-performing loan condition of bank customers. With respect to loosening, the committee believed that although it would make it more attractive for Nigerians to acquire assets at cheaper prices, thus increasing their net wealth and therefore stimulate spending as confidence rises, it nevertheless felt constrained that loosening at this time will exacerbate inflationary pressures and worsen the exchange rate and inflationary condition. The committee also felt that loosening will further pull the real rate deeper into negative realm as the gap between the nominal interest rate and inflation widens. On the argument to hold, the committee believes that the effects of fiscal policy actions towards stimulating the economy have begun to manifest as evidenced in the exit of the economy from the 15-month recession. Although still fragile, the fragility of the growth makes it imperative to allow more time to make appropriate complementary policy decisions to strengthen the recovery. Secondly, the committee was of the view that economic activity will become clearer between now and the first quarter of 2018, when growth is expected to have sufficiently strengthened and gains in receding inflation very obvious. The most compelling argument for a hold was to achieve more clarity in the evolution of key macroeconomic indicators, including budget implementation, economic recovery, exchange rate, inflation, and employment generation. In consideration of the headwinds confronting the domestic economy and the uncertainties in the global environment, the committee decided by a vote of 6-1 to retain the monetary policy rate, MPR, at 14% alongside all other policy parameters. In arriving at this hold decision, the MPC commits to employing maximum flexibility to guide the economy on the path of optimal growth. Consequently, 6 members voted to retain MPR and all other parameters at their current levels, while 1 member voted to lower the MPR to signal an ease to the current stance of tight monetary policy.